Coming up on today's show, inflation is hot, markets pull back, and where we go next. Donald Trump to execute more tariffs later this week. Small caps are trading at a historical discount to large caps. In my opinion, if I think you should buy, hold, or sell. And of course, we need to talk about earnings and what it means for the market looking ahead in 2025. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks were largely lower on Wednesday as investors digested hotter than expected January inflation data as well as Trump's reciprocal tariffs. And guys, it was a very red day today, broadly red, broadly stocks declining on some hotter than expected inflation data, but there were some green outliers. You could see here that some of the semiconductor names, AMD was up ever so slightly, same with AVGO, and a lot of the software names, stuff like Uber was up 3%. Bill Ackman had a presentation on Uber and Pershing Square's holdings. As a result, a lot of those names were up. But we did also see a gain here in Apple, up 1.58%, along with consumer defensives. I've seen a lot of people make the case that Apple is actually more of a staple company now. And we did see staples rally on the back of the declines we saw today. We did see a little bit of a defensive rotation. However, there were cyclicals that did rally. For example, my portfolio was actually very green today because Meta and Visa, my two biggest holdings, were up 0.67 and 0.17%. PayPal was also up today, so too was Evolution Gaming, and then Tesla for some reason up 5%, but I think this is somewhat of a rebound. The stock had been down 30% from its highs, and so we're just seeing a little bit of a bounce back after a 25 to 30% a drawdown from Tesla. Will it continue? I don't know, we'll see, but one thing is for sure, do not bet against Elon Musk. Nonetheless, we saw broad-based declines across the board, the S&P 500 down 0.26%. I'm going to be honest, the S&P 500 was largely resilient today. When I saw the inflation data news, and we're going to talk about what it actually meant, when I saw the CPI data, I thought stocks were going to be down like 1.5%, 2%. But the SPY, largely resilient. However, there were only two green sectors here today, XLY with Tesla and XLC on the back of Meta. Other than that, we saw the next best sector, or I should say commodity, was gold, which was pretty much flat. And when compared to the S&P 500, you actually see huge alpha right there. So definitely there was a rotation happening under the hood with regards to gold, inflation, and some of the tariff news as well. And then every other sector lost, energy being the worst performing, down 2%, real estate up 0.74%, materials up 0.66%. And guys, materials and energy are like inflation hedges, and we got hotter than expected inflation and we saw those stocks fall. Very weird price action. Real estate was down on the back of the movement we saw in yields. All in all, XLI, financials, technology, even staples, some of these defensive names, they were all down relatively speaking. And it was just a broad-based red day, yet I would say somewhat resilient day in the market. I mean, the large caps held in there. They definitely performed the best compared to the broader market. The worst components of the market was definitely like this value and core segment of small caps and mid caps. And then we actually saw small growth outperform everybody, up 0.02%, largely flat. But yeah, definitely some form of a rotation going on in the market from this like value and core segment to the growth segment here in small size, and then probably from the mid caps here into large size. And again, it's relatively speaking, even though these sectors were down as a whole, there definitely were some underlying winners that capped the losses for these, and that's the rotation we were looking at. I would say that with today's price action, it was less of a liquidation and more of a selective rotation, particularly into stuff like gold, stuff like Tesla, Apple, some of the staple names, and some of the other names, stuff like Visa, Meta, were showing a relative strength. And I don't think we actually saw a liquidation, definitely like an underlying rotation. And ultimately, the reason why markets fell today had to do with CPI data we got. It came in hotter than expected, and there's just no two ways to put this. It was just hot data. Look at core. Look at the core inflation rate month over month and year over year. The expectation was for 0.3 and 3.1. 3.1%. We came in at 0.4 and 3.3%. The headline inflation rate, the expectation was 0.3 and 2.9%. We got 0.5 and 3% for the year-over-year figure. And that is why markets sold off today. Harder than expected data. No one saw this coming. I think everybody was sort of pricing in a 2.9% inflation rate, particularly this number. I think this spooked markets really early on as well. But markets were resilient in the face of all of this. And then looking at what this did to the yields market, bonds did rise, and now the market is only pricing in one Fed rate cut for 2025. That's likely going to come probably at the September meeting. It looks like it, but definitely the back end of the year. So, I mean, if we get like just one more hot inflation data, there could be a scenario where we get no cuts priced in for 2025. What also didn't help markets today was Trump coming out and announcing that his reciprocal tariffs will likely be implemented by Thursday or possibly next Tuesday. So we're looking for tariffs sometime in between Thursday and next Tuesday, guys. And he said he plans to slap reciprocal tariffs on every country that imposes import duties on the US. So we had a double whammy from two sides, from the actual data today as well as Donald Trump, and that is why markets were very, very shaky in light of everything. We also got day 2 of Jerome Powell's testimony. There's virtually nothing to come from this. He pretty much reiterated the same thing, but he also said that his decisions and interest rate decisions won't be based on political pressure, even if it's coming from President Trump. And so the Fed standing firm, even after Donald Trump went on tweet storm saying the Fed need to lower rates. Now, looking at some market movers today, guys, we already spoke about this. Tesla was up 5%, and having been in a drawdown from its highs of about 30%, we are seeing a little bit of a comeback here. I don't think there was any news with regards to Tesla, none that I could find anyway. So some form of a dead cat bounce, I guess. Maybe bulls finding value, but up 5% today, and that's a pretty strong move and really helped some of the mega caps outperform. CVS Health reported earnings. It was up 15%. Now, they actually beat Wall Street's expectations for fourth quarter, and some of the business segments are starting to trot out. The market really liked it, and we'll see if this momentum can continue. There was actually a lot to love in this report, relatively speaking. If you're looking at trying to buy like a comeback play between CVS and Walgreens, I think CVS is where you want to be right now. And then SMCI up 3.8% after its earnings yesterday. Now, they reported very mixed earnings, but their guidance was crazy. They were guiding for something like $40 billion worth of revenue. Their market cap right now is $24 billion. Look, if they hit their revenue targets, SMCI is super, super cheap, but there is a ton of accounting fraud in this name. They're not even up to date with their listing filings. There's literally like the delisting risk in this name, that like it could be delisted off the NASDAQ, and you just don't really want anything to do with this type of management team. So I'm not personally in it, but I definitely can see the value in this name. And then for all of the price momentum we saw today, we only had 2,400 advances, 3,700 decliners. We saw net outflows in the NASDAQ 100, inflows in the New York Stock Exchange, and definitely outflows from the highs of the day here, definitely midday when we got some of the Trump tweets and Trump news. So we definitely saw outflows in these names, while the S&P 500 sort of did put a bottom in here and then continued to make higher highs while still slightly down on the date. And then, guys, looking at market momentum, shorter term and medium term averages not looking that great, but longer term averages tell us that this is an opportunity to buy the dip, and we really did see that in the price action today. The most surprising thing today was just the overall resilience of the market. Now, look, we are down here in the S&P 500, and we also are down here in the Qs, so a red day for sure. However, I really did think we were gonna be 1 to 2% down in the S&P 500, the NASDAQ 100, and the market showing a large resilience here. Now, the S&P 500, the NASDAQ 100, the IWM, the RSP stocks across the board were pretty red, particularly here in the small cap space. The IWM down 0.86%. Look at profitable small caps, look at profitable mid caps down 1.18% and 0.72% respectively. Yields were up as a result, to be expected. The 2-year, 10-year, and 30-year yield all gained. The dollar largely flat. Bonds as a result fell. Bitcoin was up 1.31%, so maybe an inflation hedge going on right there. However, still well below its high of 106,000. Gold was up ever so slightly. Silver was up in a very big way, and WTI fell 2.48%. And that's probably a big reason why energy was down the way it was today. But yeah, look, guys, we are about 10 minutes from the market close. The market trying to rebound right here, but we are definitely going to close probably red for the day, slightly flat. But again, extremely resilient market. Bulls and dip buyers came in a very big way, bought the dip, and we just made higher highs, higher lows. This is the type of price action you see in positive gamma, and that's simply where we are today. If we're actually assuming we are in positive gamma, you can see, yes, we made a low, but the bulls came in, the dip buyers came in, and we are still in positive gamma. However, on a technical basis, look at this. We put an all-time high right there, and we put a higher low and a higher low with a lower low and a lower low as well. So right now, as long as we can hold this low right here, which ultimately you want to hold the gamma flip, if we can hold this low and or the gamma flip line anywhere in between here, if markets can do that, then probably go ahead, put in a higher low, relatively speaking, and then we can go march onward and upward from there. However, this price action not looking constructive right now, and the S&P 500, and I think stocks as a whole, continue to just digest everything that's coming their way. There's been a lot of news, a lot of earnings, a lot of data. Donald Trump, that's what the market's doing right now. It's digesting that news by making lower highs on the way down. As long as we don't make a lower low, we can still actually be in an uptrend. But if we do make a lower low relative to this 59.20 level right here, things can get very, very ugly for the S&P 500. So the bulls have quite a bit of room to work with, don't get me wrong, but there are risks, especially if we break this gamma flip. Nonetheless, I thought stocks were very resilient in the face of today's inflation data. That's just my opinion. When I saw the data, I genuinely thought S&P 500 down 1.5%, very, very ugly day, and largely resilient in my opinion. I mean, look at the Qs, flat on the day, and we're about 8 minutes from the close. Very interesting trade. Now, looking at the Nasdaq 100, we see a very similar situation. While we haven't made 3 lower highs in a row, we did put a high right here and then an equal high, slightly higher high right there. And as long as we hold this gamma flip zone right, I think you just buy the dip and aim for probably all-time highs here in the Nasdaq 100. This is actually looking largely constructive in my opinion. I think looking technically better than the S&P 500, but again, you're just looking at nuances here. As long as we're in positive gamma, and as long as we hold the gamma flip, I think those are some buying opportunities in face of what is a pretty resilient market on the back of hotter than expected inflation. Looking at the RTY, so this is what we said would probably happen. You can see we slid here into negative gamma. We didn't quite get to the put support, but had you bought right here and aiming for us to retake the positive gamma zone, probably will go back there. So tomorrow, if we go ahead, retake the gamma flip, the next target will be the 23.25, and then our next target will be breaking that to move onward and upward. But we are digesting a lot of earnings right here. But right here in this zone, we are digesting just everything that's coming our way. The market in wait and see mode, and I do think this digestion phase is probably going to continue probably for the rest of February. This is simply the price action we get in February. There are no winners, there are no losers, just a ton of volatile price action that whipsaws investors in and out of positions. The best way to handle the trade we get this time of year and in a third year of a bull market, guys, is simply to be patient and do nothing. That's the best thing you can do in times like these. Looking at the RSP, again, largely constructive. I think as long as we hold this level right here, I think we look for an opportunity by the dip for us to continue the move higher. We've broken out very clearly here, digesting gains. It's now time for us to make the next move higher. That is a process. It does take some time. It doesn't just happen in one single day unless your stock is Tesla. For now, you know the game plan. In the S&P 500, it's buy any movement we get here to the gamma flip. Our target is still the same, 6100. If we break the gamma flip and make a lower low relative to this low, that's where things will change and my outlook will change drastically for the S&P 500. Same is true for the Nasdaq 100. If we go ahead and break gamma flip, we go ahead, break that, things are going to get very ugly for the market. For the RTY, I actually think we probably want to buy anything in the negative gamma. And again, unless we actually go ahead and break the put support, but in that case, all bets are off. But I'm actually liking the RTY right here. I mean, small caps had never been this cheap relative to large caps. The last time we saw such a discount discrepancy between the two was in years like 2020, 2000, 2002, where small caps went on to outperform for like the next year, 2 years. And in the case of 2002, small caps outperformed, up until 2008. That was 6 years of just like outperformance from smalls. So definitely, when you get this type of price action, I think you do want to load up, but maybe not necessarily in the Russell 2000. I would look at something more like the S&P 600 portable small caps. This is a very good index if you want small cap exposure. And guys, let's talk about sentiment. This is Goldman Sachs bull bear indicator, and this is more of a long-term sentiment indicator. This is where we are right now. The Goldman Sachs bull bear indicator is hovering around the 70% mark, a level associated with elevated downside risk when we look at previous scenarios here in 2020, here right in 2008, here in 2001, as well as in the 60s and 70s. So yes, based on this market indicator here, which is heavily weighted towards valuation, we probably are at the top end of the range. However, when you look at a lot of these scenarios and how long this timeline is, yes, when we do get to this level right here, we are technically overvalued and there is downside risk. However, we can stay in this overvalued territory for a good number of years, like we did here in the year 2000, very similar to the environment we're seeing right now. Pretty much from 1995 all the way to like a middle of 2000, we stayed in this overvalued territory, and this was a great time to hold equities. You just had to get out at the right time. We could see a similar situation right here based on the current macro and fundamental environment. I don't think equities are going to fall apart, but do expect volatility. But let's move away from the very long term and look at what equities have done in the last week. And this is the relative rotation graph, or the RRG. It essentially tells us what's leading, improving, and what's weakening and lagging. In other words, what's bearish. In the last week, we've seen technology and comm services improve significantly, and we've actually seen stuff like financials, industrials, energy staples, and utilities actually lag and weaken, relatively speaking. Anything in this quadrant is sort of like leading, anything here is lagging. Above this, you're improving. Below this line, you are weakening. And if we are to break it down into more nuance, we could see that leading lately has been tech and comm services, and also discretionary, although we have seen it weaken relatively speaking. What's weakening as a whole though is generally financials. What's lagging is industrials and energy, materials, real estate, healthcare, and staples as a whole. And there's not really any sectors really improving. You could say healthcare to a degree, but all in all, what this is really showing us right here is we haven't really seen a clear leader. This is just in the last week, and the reason why we've seen tech, comm services, and discretionary lead in the last week is because all of these sectors were leading the week prior. You can see here energy, industrials, financials were leading the week before that. So 2025 is going to be a year where we do broaden out, and if you are in technology, you're going to do very well, but if you also are in other parts of the market, you're going to do generally well as well. But let's talk about seasonality and the S&P 500. And February seasonality is better but not strong normally after an up January, with the S&P 500 up 60% of the time on average, with a return of about 0.47%, 0.67% median. After an up January in a presidential election cycle year one, the S&P 500 is up 57% of the time in February, with an average return of negative 1.25%. So, however, a median return of 0.73%. So do be aware that in the presidential cycle, we can definitely see quite a lot of volatility, particularly when you look at average versus median. And that's kind of what we've seen in February. It's been very volatile. However, the fundamental backdrop of this market has not changed. In fact, it's improved significantly. Guys, looking at blended earnings growth, 308 companies have reported in the S&P 500, 76% reporting above analyst expectations. And look at this, 14.8% earnings growth. And if you remove the dumpster fire that is energy, you're looking at 18.2% growth. Guys, you're looking at mid-teens, close to 20s growth just for this quarter. Very strong stuff. This is the type of stuff you want to see in bull market, and it's why I say the fundamental picture looks strong, and I don't think the market is gonna implode because of this. Yes, we will have rotations taking place, and there will be upside, there will be downside, but I don't think anything is going to bring a serious bear market right now. Things look very good. But when we do look at risks to this market, investors see sticky inflation as the the biggest risk? Goldman Sachs had a quick poll question. What is the biggest risk to US exceptionalism? 37% of people said sticky inflation, 24% said tariffs, 13% said AI competition. This is probably telling us that the DeepSeek stuff was more of a rotation more than it was serious risk coming into the market. 17% said growth, or I'm going to assume this means a growth scare, and then other was 8%. So you're probably looking at stuff like maybe the China invasion, Russia, that type of stuff. So the real material risks in this market is probably tariffs, sticky inflation, and then I would add there a growth scare if we are to see that. Very interesting. However, guys, when we do look at the overall macro, we do know that the macro is robust. However, we do need to understand what's happening on the monetary side of the market right now. The US government will soon begin a drawdown of the Treasury General Account. This is the TGA account, and this could mean a liquidity injection totaling up to $830 billion. And functionally, this is similar to QE. So let me explain what's going on. The US government hit its self-imposed debt ceiling of $36 trillion in late January. This means that the Treasury can no longer take on additional debt until a new debt ceiling agreement is reached. This has historically involved raising or suspending the debt ceiling. The Treasury has since been deploying emergency measures, a total of roughly $338 billion, in what are essentially accounting gimmicks and financial maneuvers. On Friday, February 7th, the government had used up more than 60% of these measures, with only $133 billion left. That means probably this coming week or next week, the Treasury will be forced into drawing down the TGA to fund spending until a new debt ceiling agreement is reached. So what does a TGA drawdown mean? The TGA can be thought of as the government's bank account at the Federal Reserve. It currently has a sizable balance of $830 billion. This money is currently set, so it is removed from the markets. If the government begins to draw down the TGA, this is an injection of new liquidity into the markets. A TGA drawdown and quantitative easing are functionally similar in that they both inject liquidity into the financial system by increasing bank reserves. While not strictly QE, it looks like QE, sounds like QE, and smells like QE, which is why it has been dubbed not QE, QE. And the impact of debt ceiling induced TGA drawdowns on financial markets can be similar to QE on a temporary basis. In the past, significant TGA drawdowns have generally coincided with asset price appreciation, as you can see from this chart right here. The TGA in 2022-2023 started halfway through the bear market and was arguably one of the main factors halting the bear market. So, what's the TGA path right now? Analyzing all of the components of the TGA, treasury spending, borrowing, and expected tax intakes, my rough estimated path for any potential coming TGA drawdown is this right here. Any potential prolonged TGA drawdown will straddle two tax intake periods, April and June, so it will be punctuated by two short-term TGA balance increases or liquidity drains. The first portion will take place between roughly mid-Feb and early April, and I estimated it'll be a total of about $600 billion in liquidity additions. The estimated path in the chart above won't be perfect, but it is a guide as to what will likely happen. It could vary as time passes. How far along the path we get depends entirely on how quickly lawmakers come to a new debt ceiling agreement, what is known as the X date. The day that the US government officially runs out of money is currently looking like it'll probably be some point in August. This TGA drawdown is practically set in stone and is essentially non-negotiable if the US government wants to keep functioning. If lawmakers follow a similar debt ceiling discussion path to previously, they will leave things late and finally come to a new agreement at some point in July/early August. This will allow for a significant TGA drawdown. Now let's talk about earnings for the rest of the week, guys. Tomorrow is Thursday. Before the open, we have Datadog, CyberArk, John Deere, Crocs, Duke Energy, Sony, GE Healthcare. And after the close, we have Coinbase, Twilio, DraftKings, Applied Materials, Airbnb, Palo Alto, Roku, Wynn Resorts, guys, it just continues. A pretty big day on Thursday, and we also have a couple of big names here on Friday, but we'll tackle them in tomorrow's video. And then tomorrow, guys, we have the PPI month over month. The consensus expectation is 4.3, and then Friday we have US retail sales. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.